Arora, the founder of the Arora Report. Nigam, thank you for being with us this afternoon. Always great to have you on this show. I want to dive right in to what we've got going on in Japan today. I know back when you were on with us back in October, you were talking about the rising yields in Japan, that investors need to keep a close eye on this. Now we're seeing BOJ yields hitting levels we haven't seen in more than a decade today. How real is the risk that the yen carry trade begins to unwind here?
Well, Marley, thank you for having me. The risk is real. Great question. The reason the risk is real is that, we don't have exact estimates. We're all guessing. But rough numbers, there's about $1 trillion in a carry trade. $1 trillion is a lot of money. So that's one. And the second is the funds that use the carry trade also use very large leverage on top of it, right? So what we're seeing in Bitcoin right now is a result of excessive leverage. So in the AI trade, which last 2-3 years, funds have been borrowing in Japan and investing in AI stocks here, and before that, borrowing in Japan and investing in US treasuries. In addition to the movements between yen and dollar and rising yields in Japan, there's also a lot of leverage. So a little bit of move in yield means a lot because of the leverage. So the risk is very real. So I would say this, on a macro level, I'm not talking about geopolitics, I'm not talking about inflation, those things, but just over macro level related to currencies and carry trade and borrowing, we now have probably the highest risk since 2008. So that's pretty high risk.
So if it's pretty high risk, how exposed is the U.S. AI trade if we see these leveraged funds forced to unwind yen-funded positions?
I think it's very, very exposed. We could easily see 10-20% correction somewhere here if the carry trade unwinds.
And if we start to see these global rates diverge, we see Japan go up while the expectation is for the Fed to move towards easing, what do you think the most likely market reaction would be?
Well, so it's kind of interesting. Back in 24 September, when Fed was going to cut rates, everybody knew that. The only question was 25 basis points or 50 basis points. And everybody was rushing into long bonds, the U.S. long bonds, treasuries, and so on, saying because the rates would fall. And 10-year was in mid-threes, 3.6, somewhere around there. And my call was, if Fed were to cut by 50 basis points, the long yield would rise. And, people kind of laughed and say, how could that be, right? Well, Fed cut by 50 basis points, and the 10-year rate went up to like 4.3%, so it rose quite a bit. Can similar thing happen again? Possibly. But now we've got a lot of other things going on, which we didn't have before. We've got this big move for stable coins, and then, stable coins have to be backed by treasuries, so they're buying treasuries, usually shorter term, but there is some impact on the long term. So it's uncertain what happens. But I think investors should be open to the possibility that as Fed cut rates, long-term yields may rise. And part of it will depend on, what the statement is that accompanies it, right? It could be a very hawkish cut, right? Fed may say, we're cutting, but, we shouldn't be cutting, So that's that. And the other development that's on the horizon is anytime President Trump is going to announce new Fed chair. And question is, market is a favorite right now, but maybe it's that person, maybe somebody else. And since President Trump is appointing that person is going to come out and say, hey, I'm going to cut rates. So how does the market react, right? On one hand, what we call the Momo crowd, the momentum crowd is going to go crazy. The rates are going lower. Let's buy. On the other hand, we're saying, hey, is Fed losing its independence? Are they now going to fight inflation? And then we see that yield differential between Japan and US and the carry trade blowing up. So there are going to be a lot of cross currents here. So all I can say is be open to possibilities, either way.
And Nigam, you come on the show a lot. You make these predictions, and then a lot of the time we have you on the show next time, and some of those predictions have come true. So as I was reading through your morning capsule, your probability of a December cut is about 70%. Right now, the market's pricing in higher than an 85% cut. Now, I know some of what you just mentioned is probably tied into what's missing in between your two numbers, but I'd love to know more specifically why yours is under. What's the market missing that you feel less confident about this cut?
Well, so when we look at the inflation data, inflation is still running around 3%, right? We see some weakness in employment, but not a lot. So now Fed has a dual mandate, okay, employment versus inflation. And, I've been a student of Fed for a long time, doing this for a long time, have made a lot of accurate calls about the Fed. The data really doesn't justify cutting rates, but Fed is likely to cut rates. And then there's a, segment in Fed, some people want to do what President Trump wants them to do. Other people want to take a stand, right? So there's some kind of thinking going on that when the new Fed chair comes, the new Fed chair is going to push for rate cuts going even lower and lower. And some members of the FOMC want to take a stand now so that when the rates are cut in the future, they don't end up getting too low and the inflation getting out of hand. So there are a lot of dynamics going on. So that's why I think the probability is about 70%, where the market is, if you look at a CME, Fed Watch, it's around 85, 90%.
Yeah, right now 85.4. Now staying with the cut, we've got the cut coming. Potentially, it's looming here for December. Next week, we'll know. We've got QT ending today as we've hit December 1st. I want to pivot to your metals play here, though, which is sort of potentially tied into QT ending. Is this a structural moment for precious metals, particularly for silver? Because you have some pretty strong thoughts about silver.
Yes. So silver, we think if there is a Fed rate and, statement is not hawkish from Fed and so on, silver could hit $70. Silver is prone to short squeezes. And, we can go back to 1970s when Hunt brothers tried to corner the silver. Then we had few years ago, meme crowd going crazy. Silver is a smaller market, and there are lots of shorts in silvers, and we saw that on Friday in the futures before the regular stock market opens. We saw a lot of short covering, and that carried through, and that's still carrying through today. And these short squeezes can be vicious. So I think silver has a possibility of being squeezed much higher here.
Yeah, certainly possible. We saw gold touch a 6-week high today, and looking at silver now, they're up almost 3% at 58.77 though. So 70 is a way to go there, but I don't doubt you. I don't doubt you, Nigam. Every time you come on, you say, last time I was on, I said this, and a lot of the time you back it up with, and then it happens. So thank you for being with us, for your insight as always. That's Nigam Arora, the founder of the Arora Report.